UOB and OCBC have just announced higher dividends. Congrats to the shareholders holding on to the 3 SG Bank stocks. In this video, let's go through the bank's results and see if the current share prices justify the 3 bank stocks. For UOB, they have the potential of huge growth in non-interest income due to the expansion and integration of the consumer business that they have purchased from Citibank. So it's important to see that as they integrate these businesses, it should benefit their business as a whole. Straight off at their key highlights, total profit is down 5% quarter-over-quarter, with fee income down 10% quarter-over-quarter. It's common in the fourth quarter of bank financial year that non-interest income be lower due to a low activity season. For the year-over-year result, it has still done very well. With higher profits, higher dividends are expected as banks usually give 50 to 60% of their profit as dividend. Higher dividend of 92 cents per share was announced with additional special dividends that I will elaborate on later. Not much changes to their non-performing loans and CET1 ratio, while ROE has dropped to 13.3% for the second half of 2024, and this is expected considering the drop in the fourth quarter's income. Looking at their balance sheet, net interest income is stable and is a win for the banks considering their net interest margin has been coming down due to lower interest rate. For UOB, the non-interest income is the total from the fee income and the other non-interest income. For this quarter, it did not come in well with double-digit drop Q-over-Q. This is expected due to the slow season, but for the full year, non-interest income was up with net interest income at 0%. This led to lower net profit, but because of the strong Q3 financial year 2024 report, they are able to announce higher dividend and share buybacks. This slide summarizes some important parameters for UOB Bank. The increase in 19% in CASA means that there are more money being put into UOB savings account and is definitely beneficial for banks to earn more interest income from this cash. Card billings and wealth management increased by 12% and 30% respectively, which is important for their non-interest income. The growth was thanks to the acquisition of Citi consumer businesses. Loan margin decreased to 2.48%, which is expected, but the interest income was able to stabilize, most probably due to higher amount of loans being used. In conclusion, net interest margin will be expected to continue to drop. But as long as there is higher deposit of money by the public and higher loans taken, this will help to offset the drop in the margin. Fee income dropped 3% Q-over-Q due to softer season, but if you look at the year-over-year result, it's up 11% for financial year of 2024. For this quarter, the treasury and trading income normalized back from the last quarter's high. Overall, the bank did decently with 15% increase year-over-year. It's important that the year-over-year results continue to increase so that the dividends that they give will also increase year-over-year. Cost-to-income ratio is an important parameter as it's another way of showing the cost efficiency of the bank. For UOB, if we exclude the one-off expenses, it comes in at 45%. Because the integration from Citi consumer business is still undergoing, there is additional cost incurred resulting in higher cost-to-income ratio of 45.6%. For this quarter, with the drop in the income and the cost remains the same, it's expected that the ratio increases. However, we will have to observe for the subsequent quarters to ensure that it does not continue to increase. No changes to their non-performing loan at 1.5%, which is a very safe level for Bank International standards. Similar to DBS, with the International Standard Basel III reforms implemented, UOB CET1's ratio went up to 15.5%. For this quarter, it has maintained well at 15.5%, which shows the amount of excess capital that the bank has. As shareholders, it's very important that companies are willing to reward shareholders by either increasing the dividends or doing share buybacks when they have excess capital. With the income growing, the potential for dividend growth is definitely possible because banks usually do dividend payout at 50 to 60% of their income. Dividend went up from 88 cents to 92 cents. Moreover, they have announced capital distribution of additional 2 times 25 cents through the 2 halves of financial year 2025 and additional 2 billion of share buybacks through 2025 to 2027. In their outlook, they would consider a single-digit growth in their loans while double-digit fee growth is expected. This will lead to higher total income and hopefully higher profit. Thanks to the higher dividend announced, the dividend yield will come in at 6.1% at their current share price. This is the current difference between the banks and the REITs. Banks continue to perform well with higher dividends, while REITs are experiencing drop due to higher interest rate. Next, let us go on to OCBC earnings. OCBC was good, but the growth was slower this quarter as compared to UOB and DBS. Looking at their key highlights, the first thing they always focus on is their net profit and the total income. Group net profit increased by 8% year over year, which is good, with total income increasing 7%. Both interest and non-interest income is up year over year. For banks or companies that gives dividend depending on their profits, it's definitely a good thing as they can potentially increase their dividends. Return on equity came in at 13.3% for this quarter, which is lower than DBS but similar to UOB. Non-performing loans is at a low ratio of 0.9%, and similarly to other banks, CET1 ratio is at a high of 17.1%, which means that they have a lot of excess capital. Because of the good income growth and on top of the excess capital, OCBC has announced higher dividend payout ratio of 60% for financial year of 2024 and 2025, while on top of the share buybacks that they are going to engage in. They have announced a 2.5 billion capital distribution over 2 years. Looking at their result, net interest income was impressive as it was consistent when comparing Q over Q and year over year. Non-interest income increased year over year while Q over Q dropped. Like I mentioned, it was due to the lower activity season, that's why for quarter over quarter it's expected to decrease. However, due to higher operating expenses, operating profit is down 5% year over year and 21% quarter over quarter. If you look at their operating expenses, it has been going up quite consistently for this financial year. Higher expenses was due to higher annual salaries and headcounts. The consolidation of the PT Bank Commonwealth in Indonesia and the investment for future growth is also additional contributing factors in their increase in expenses. Moreover, they have also privatized Great Eastern. These expenses are good for the future growth for OCBC, so in the short term, these expenses are good. For the year-over-year result, it's good with overall net profit increase. Both customer loans and deposit increased 7% year over year, which is important as they are essential for the bank's interest income. With more deposit from customers, it gives the banks the flexibility to utilize this cash to earn more profits. Wealth management also increased by 14% year over year due to money inflow, and their insurance business Great Eastern brings in 39% higher year over year. Interest income margin continues to drop, but the interest income actually stabilizes. This is due to higher deposit and higher amount of loans given, similar to the other two banks. So even with lower margin, it can be offset with higher loan activities. Non-interest income is lower quarter over quarter due to lower insurance and trading income. However, since it's a seasonality, if we compare with the Q4 of the financial year 2023, it's higher year over year. Fee income is also important as this portion of the non-interest income is usually more stable. So we can see that it has been consistently doing well, with wealth management fees in particular increasing 22% year over year. With the good increase in the income and the increasing in customer deposit, this has allowed OCBC to continue to perform well. Their total dividends has been announced to be paid at 60% dividend payout ratio for this financial year and financial year of 2025. With regards to the outlook, OCBC gives a much conservative outlook with mid-single digit loan growth and net interest margin remain at 2%. OCBC share price actually went down after earnings. However, to me, this report is actually quite decent. At the current share price, the dividend yield will be in the range of 6.1%, as I'm assuming that their dividend payout ratio of 60% will be in the ballpark value of around 105 cents per share for the next financial year of 2025. So let us compare between the three banks for this quarter's results. All three banks experienced drop in income in Q4, particularly due to the large drop in the non-interest income. This is expected due to seasonality, but for DBS, it continues to perform better with 5.5 billion, while OCBC and UOB are on par at 3.4 billion income. Net interest margin wise, DBS is still the best at 2.77%, while UOB and OCBC is at 2% and 2.15% respectively. Net interest margin for the three banks will be expected to drop as the interest rate continues to be cut. However, even with the lower net interest margin, all three banks came in with higher net interest income. With DBS having the higher net interest margin, DBS return of equity came in at much higher at 17.2%, while UOB and OCBC is at 13% range respectively. All three banks are doing well, growing their non-interest income, but DBS has the highest portion at 32%. With interest rate coming down, it's important that banks grow their non-interest income so that it will ensure that their dividends to shareholders can continue to grow. In this quarter, even though the non-interest income is lower for all three banks, it's important that there's year-over-year growth so that dividends paid by the banks will most probably increase. Non-performing loans for all three banks are at a very safe level. CET1 ratio indicates how much capital the bank has. All three banks are at a very high level, with DBS management mentioning that 12% is a decent level, while UOB and OCBC are more conservative at 14%. That is why for all three banks, not only do they can announce higher dividends, but they also announce share buybacks. With share buybacks, these will concentrate the outstanding shares and make our shares more valuable. Even though all three banks' share prices have recently went up for the past year, their dividend yield might be still at an attractive rate with the potential for higher dividends. Thanks to the higher dividends announced, their current dividend yields are in the 6% range. In this part, I've also included their EPS and dividend payout ratio. What is so important is that with their payout ratio at this level, this meant that they are keeping a portion of their income that can be used for future growth investment or distribute back to shareholders in the future. Interestingly, for this quarter, because OCBC announced 60% dividend payout ratio, they have increased their dividend payout ratio for this second half to match the financial year 2024 of 60% payout ratio. Because of this second half 2024's dividend is at a dividend payout ratio of 71%. So we should not expect the next half of the 60% dividend payout ratio to be at this level. Thanks to the high interest rate environment, the three banks were able to constantly achieve record profit and invest a lot by doing business acquisition. However, making the right acquisition is also important, and we will continue to see which bank continues to outperform each other in this financial year 2025. Thank you so much for watching. I hope this video has been informative for you. If you enjoyed the video and would like to support my channel, you can start investing using my affiliate links to open your brokerage account below with free gifts. Please also hit the like, subscribe, and comment on your thoughts on the bank's earnings. You can also watch my previous analysis videos on the DBS Bank and the recent analysis on Mapletree REITs. Thank you, and I'll see you in the next video.